Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, we're going to be talking about Wolfe waves. And if you're not familiar with what a Wolfe wave is, that's fine. We're going to cover all of that fun stuff as well. But really just going over what a Wolfe wave generally looks like. If you were to look at it, it's effectively just a chart pattern that's composed of 5 waves, just like the majority of every other pattern, but 1, 2, 3, 4, 5. And that's the idea of a Wolfe wave, is that we have an overlying equilibrium in this move to the upside. Wave 1 into Wave 2 is very similar to Wave 3 into Wave 4, and Wave 5 is effectively just an overshot of the high. So if you were to go all the way across, I didn't draw it quite long enough, but we would get the market to go up like that and then come back down. Now, the idea here, or really the big takeaway of understanding Wolfe waves, is that Wolfe waves in and of themselves are well, it's something that just shows up all over the place. It's one of those things like Elliott wave and all of the other market structure style of things where once you see it, you can't not see it. They're just everywhere. But to recognize them correctly, we really have to identify a couple very specific things. So one of the important things here when it comes to Wolfe waves is the consistency rather in the time interval. You want them to look very similar in terms of overall movement. The first part isn't necessarily a huge portion, but the rest of these, you really want to see them fairly equal until they finally get the blow off. And even better, if you can get Wave 1, Wave 2 to look almost identical to Wave 3, Wave 4, and then you get that final move to the upside. That's the best, but again, the perfect world scenarios don't typically happen, and more often than not, they look more like what we have on the screen, where we have a really nice drive to the downside, Wave 1, Wave 2, Wave 3, Wave 4, Wave 5. And the important takeaway here is that when we draw a channel from those 2 points on the bottom and those 2 points on the top, that gives us our overall wedge or channel. And what we need to see here is that we have, again, a bit of symmetry, but the market generally stays inside the bounds of this channel until they finally reach the 5th. And when they reach the 5th wave, we're looking for the market to blow off of that area, blow through the area and break out of that channel. And really the concept here is that the market then, upon failing to make a continuation move of an overextension pattern, which is really what this is. We have a very strong move down, overextension on the third one down, very unlikely that it continues to go from the downside and keep going. It's not to say that it can't, but it's very unlikely, and that's where a lot of traders will start to look for the reversal. Now, as far as the Wolfe wave is concerned, what you really want to look for is drawing from the A to C point on the bottom and waiting for the market to transition back inside of the wedge. Just because it broke underneath the low of the wedge doesn't necessarily mean anything. It could drop a lot further. We've got to wait for that transition phase back in like we had over here. Then the market can start taking off based on the normal Wolfe wave follow through. So again, if we're looking at this, in a Wolfe wave, the 5th wave breaks out of the channel or the wedge. And according to the theory behind the pattern and what we see in generally markets everywhere, if we were to take a line drawn from A to C or from B to D, depending on which side it's going on, and we get that breakout of the bottom edge or the top edge, if you're looking short, again, these are variable, both long and short, when they start traversing their way back inside of the pattern, we should see a rotation back in the opposite way. And usually that rotation is going to go to 2 primary directions. The first direction, once we have the market rotating back inside the pattern, is getting back to the D point high, right? If you were breaking these down, Wave 1, Wave 2, Wave 3, Wave 4, that would be Wave 4 points high. So if you were to draw a horizontal line across Wave 4, that is primary objective number 1. That's what every bull on the planet is going to be looking for if they're buying down here. Now, if you look, first off, the risk reward on that is absolutely insane. If they're getting in with a risk reward that looks like this, it's crazy. But it gets even better, because if we further extend the bottom of Wave 1 into Wave 4 and draw a line across, this gives us our secondary objective. Now, the market may not necessarily reach out and grab this, but this is like the ultimate objective. If it reaches this, it's got everybody's icing on the cake, and then they put an extra dollop on top of it, right? This is the full-out completion pattern move that a lot of traders are going to be looking for. And that's drawing from the bottom of wave 1 to the top of wave 4, and that gives us a projected area. Now you can see this one didn't rotate all the way up there, but had it, that would have been a major target area as well. One of the big things when you're looking at Wolfe waves is identifying them in the first place. And one of the easiest ways to identify them right out of the gates is to look for the very ubiquitous 2 pushes where they're trying to get the third, and they've got to be making new extremes. So you've got the first, the second, then you're waiting for the third. And the important part is that that third or fifth, depending on how you're numbering them, overblows the last of the move. So as an example, if you were looking for this to be a Wolfe wave here, 1, 2, 3, 4, this just didn't go far enough. If you were to draw a line from there to there, if it would have gone like this, then it would have been valid, right? But that didn't happen. So we have to redraw and continue going further forward. 1, 2, 3, 4, 5. We have the overshot, continuation back in, rotate city, time to go. And that's really all you're looking for. It's a very, very simplistic pattern, but it's incredibly powerful. And that's the idea, right? Keep it stupid simple, or keep it simple stupid, whatever the acronym is, KISS. That's the goal here, is to make it very simple and straightforward. I would very much encourage you to go through your charts and try to find these areas. They're a little bit weird when you first start trying to locate them. They don't feel normal. They're a little bit out of the norm. They're a bit funky. But once you start getting your head around how these operate, they become easier and easier and easier to locate. And when you can find them, you can see the risk reward that they can open up is absolutely nuts. So that's going to do it for this one. Hopefully you found it useful, interesting, entertaining, and maybe something you can potentially add to your tool belt if you're not already using Wolfe waves. Of course, if you have any questions, drop them in the comments below, or if it's a more detailed question, you can always shoot me an email, jhb@ssftg.com. Until the next one, enjoy, rest up, and we will see you all then. Thanks.